Thank you for joining us. Before we start, there's a couple housekeeping items I'd like to go over. First one is we will be sending a copy of Laura's PowerPoint as well as recording to you. I think the recording will actually be on our website. So please use the chat feature if you have any questions. Laura would like to answer all of the questions at the end of the webinar. So submit them and then we'll go through them at the end. And lastly, you should be receiving a brief 4-question survey that to help us make these webinars better. So if you could fill those out, that would be great. My name is Ed Cook, and I am a Canton SCORE mentor. For those of you that don't know what SCORE is we are a national nonprofit organization. We began back in 1964. And it has grown to over 200 chapters and over 11,000 volunteers like myself. Locally, we're funded by the Stark Community Foundation, the Hoover Foundation, the Greater Canton Chamber of Commerce, and we are a resource partner of the SBA. So besides sponsoring educational workshops like this, we counsel small businesses, and that's really our tagline, our forte, so to speak. We are America's counselors to small businesses. Our counseling is free and it's confidential. So we assist startups or existing businesses that need help, whether they're for-profit or nonprofit. So if you are a small business owner and you're struggling in a specific area, I suggest you give us a call or an email. You can see the contact information on the screen, and we will pull the counselors together that can best help you. Locally, we have about 47 counselors, and they each have a very unique business skill set, ranging from marketing to banking to human resources to supply chain. And we cover a 5-county area, but really those lines have kind of disappeared these days. So if you need our help, give us a call. Our office is located in the Jackson Township Administrative Building there in Jackson Township. We can meet you there. We can meet at a Starbucks or Bob Evans, or we can do it by phone, email. So we're there in a lot of different ways, whatever works best for the counselor and yourself. So with that, I'm going to turn it over to Laura Gibbons. Laura, it's all yours.
Thanks, Ed. I appreciate it. So good morning, everyone. As mentioned, my name is Laura Gibbons. I am a senior business consultant over here at Chase. So I spend most of my days mentoring small businesses as well. Think of it more as, a couple years in business, over 100,000 in revenue, where now you're starting to think about maybe from a lending perspective or how you continue to grow from there. Which is why we love partnering with SCORE so much. The mentorship piece I think is so important, both personally and professionally, to always have somebody to kind of be a coach. I've had mentors my whole entire life, so I understand the importance of it. So just some housekeeping things. You will get a copy of the workbook. So some of the print, if you're on your phone, computer, it might be a little bit small as we're going through the presentation, but when you get the copy of the workbook, you'll be able to see everything that we're kind of talking about, some of the exercises that you'll be able to do on your own. And then, so that'll all come to you after. If you have questions as we're going through the presentation, we're not going to stop through it, but just go right into the chat and ask that question, and then we'll address everything at the end just so that we can keep everything moving. But I don't want you to forget about it. So go ahead and make sure you put that in the chat. All right, I think we will kind of get going. So if you want to take it to the next slide. All right, so you don't have to answer this, but I want you to think about this as we kind of start talking. How confident do you feel about your knowledge around business credit options? So the goal would be that if you're sitting at a 1 right now, that you're not very confident, that, hopefully you'll be at a 2 where you're going to feel that you know a little bit more. And if you're at a 2, that you might be moved up to a 3 to feel that you're kind of ready to dig a little bit deeper on it. This by far is one of my favorite presentations because I was a lender for over 15 years. So credit is my forte. So we're going to dig into some of the specifics to, better prepare you for going in and asking for that loan, and also what is available to you as well. Okay. So next slide, please. So here's some things we'll cover today. So think strategically about why cash flow is so important to the survival of your business. Does your business actually need to borrow, right? So we'll give. Was I muted?
Yeah, yes, you were. You're muted right now, Laura. There.
Okay. Was I the whole entire time?
No, you just went
Okay.
out at
Okay.
part two.
Something had popped up and said to unmute. So, okay. Sorry about that. All right. So, does your business need to borrow? So questions you need to ask yourself before you even consider a loan, right? A lot of times we think borrowing is the answer, but there's some questions that you got to kind of think about first. Then look at the bigger picture. So there's an activity that we'll do. Like I said, you can do it in your workbook when you get it, but we'll kind of briefly talk about it to understand whether it makes sense for you to borrow right now. The biggest one, which is what financial data is important. Okay, so we'll do a brief outline of some of the data that loan officers are going to want to look at, and what those terms actually mean. Okay, and then what are your credit options? So the different ways that you can borrow for your business. All right, so let's take it to the next slide. So let's talk about cash flow. You can go one more. So when you have money you can spend right now, you have the flexibility to take advantage of opportunities and challenges as they emerge. Okay. Um, a lot of times people say, I've got money in the bank, right? Well, money in the bank is just going to get spent every single month, right? Cash flow, which is money coming in every single month, is what keeps the business actually flowing, right? Because it takes cash to conduct daily business. For all the examples that you see right in front of you, right? It enables businesses to make quick decisions about when and how to invest their time and resources. You're going to use your cash to pay your suppliers, pay your employees, rent your space, reinvest in the company. Like I said, if it's just the money that's sitting in the bank and nothing else is coming in, that money's going to be gone pretty quickly, right? So let's go to the next slide. And here's a perfect example of how a company can kind of experience a cash flow shortage. So let me read this example for you. So Tiffany's business has found a niche. She's busy serving clients. She hires help and ramps up her business, buying a lot of equipment, ordering lunches and dinners for her team because they're working late hours. She gets a call from her bank that her accounts are overdrawn. She looks at her invoices and sees that many have not come in yet, and a lot others are not even due yet. So it's going to be weeks before she has the cash on hand that she needs. So next slide, please. So think about some of the cash flow takeaways with this story. Number one, cash flow needs to be managed. There's so many times that we are not using an accounting system or some kind of a record keeping to understand how money's flowing in and out of your business. It's impossible to know uh, if you're not keeping track of if this money is not earmarked for something else. Okay. You have to have an efficient process for payables and receivables. So in an example of payables, using an online banking for a perfect example, if you're still using checks, you could write a check today and you've got to pretty much essentially say that that money's out of your account, right? But if you're doing online banking, you may be able to wait until maybe next week, a day before that bill's due. And now you've given yourself another 7 days potentially to have that cash to maybe potentially do other things in your business, because you may now get a couple of other, receivables in, right? In that 7 day period. So having an efficient way on that payable piece. Now, the receivables piece is another thing that's really important. If you're in a service type industry where you're billing someone, okay, you can't pay with invoices, right? So you have got to make sure that you're also setting time aside to make sure that once that job's completed, you're actually getting those invoices out to be able to receive that money in. And just because you send that invoice doesn't mean somebody's automatically going to pay it, right? Now you got to have another process in place to say, hey, if it's not there in a week or 2 weeks or 3 weeks or whatever your process is, I got to get that sent out again. Okay. And that's going to help you better manage that cash flow piece of it. And then obviously borrowing capital strategically can also help you ensure that you have that cash when you need it, but making sure that you're borrowing it at the right time and not just making it another debt for yourself, which we'll talk more about. Okay, so let's go to the next slide and let's consider a few perspectives on whether your business actually needs to borrow. Okay, so the next slide is going to be the most important thing that I say in this whole entire thing is to remember that when you borrow capital, you need to have a solid plan for how to pay it back. Okay, this is what the bank is looking at. A lot of times people say, I don't know, I submitted for a loan, they won't approve me. Well, at the end of the day, it's because if your business is not showing any income, then it looks like you don't potentially have any money to pay back a loan, right? So that's a really critical piece of it, is to be able to show that you do have some way of paying it back, even from a startup perspective, right? If you have not done those projections and really understand, hey, this is how many units of something I need to sell every week in order to make enough money to pay my, expenses and have money left over to potentially take on this debt. We want to see that you've done that math, that you even understand, hey, this is what it's going to take for me to be successful, right? Instead of going into it blindly. All right. Okay, so next slide. So here's what lenders want to know. And we're not asking to be super intrusive, even though a lot of times people think that, but there's a reason why we're asking, right? So like, for example, the very first question, how long have you been in business? The reason that we're asking that is because if you're a startup business, I'm going to ask you for a completely different packet of information than if you've been in business for 5 years. Okay, so that's why it's important to be upfront and tell us, because if you say, hey, you don't tell us how long you've been there, and I say, hey, I need 2 years of business tax returns, and you're like, well, I just started like 6 months ago. Oh, well, then that's a whole different packet. Now we need a business plan, projections, personal tax return, right? We're going to look at it a little bit differently. Is your business profitable, right? A business that's making money, like I said, is the actual best candidate for credit, because from a lender's point of view, you're telling us that you're, in a strong position to be able to pay us back on that obligation. Okay. Just like negative cash flow is a signal that a business could have trouble repaying that loan. Is your business seasonal? We ask that, if you're a landscaper in the summer, but you don't plow in the winter, that's okay. But we have to understand your cycle, right? Because you're not going to have any money coming in for 6 months out of the year or 5 months out of the year, right? And that's okay. But if we were to look at a balance sheet or an income statement, it's going to be all wonky because of your dips throughout the season. So it's important for us just to know that. Do you need to build credit? Is it just a question that you just don't have any because you're a newer business and you haven't taken the steps to kind of build that business credit, which we will talk about here a little bit further as well. And then, are you looking to expand, right? So if by maybe adding employees or new locations, your already profitable business can increase revenue ability, then you may want to use credit to begin that expansion. And potentially it's equipment, right? Will new equipment help your business? If essential equipment's limiting your growth, it might make sense to borrow to increase your revenue potential. But we need to know that. If you come in and say, hey, I'm looking to get a line of credit because I want to buy some equipment, that's not the right way. That's not the right product for it. Okay. And we'll dig into that a little bit too. But just having this base knowledge is going to help you to understand what it is that you actually need for what you're looking to do. Okay. All right. This next one I always just throw in there. The word credit means a lot of different things in different contexts. But in this presentation, when we talk credit, that means an agreement between a borrower or a lender, such as, a credit card, a line of credit, or a loan. Okay. All right. So when you get your workbooks, we're going to just briefly talk about this. There is a little kind of, you can go to the next slide just to kind of show what it looks like. There's a little kind of exercise that you're going to do. Okay. And it's that you kind of need to ask yourself before you think about taking on a loan. And a lot of it talks about the environment, your operations, and the final one is the opportunity. So like, for example, the environment, how has the last year changed the way you think about your business? Or who are your competitors? And what have they done to adapt in the past year? I've said this in a lot of different classes. You can learn a ton from your competitors, right? This is how do they market? What areas are they going into? What does their pricing look like? Have they increased their prices in the last couple of years? All these things are what keep you competitive in the market, right? But you got to ask yourself, some of these questions of what maybe what they're doing to see what things you want to emulate and what things you don't want to do so that you don't fall into those traps, right? And then when it comes to your operations, what steps have you taken to prepare for a setback? Do you have a plan or you just plan on winging it? Right? I always say if you didn't learn anything from COVID about what catastrophe could look like as far as having your business shut down, people had to pivot in seconds to move to online platforms and all these types of things. So now that we've had that insight, the question is, what kind of a plan have we made to potentially make sure that that doesn't happen, or that we're prepared if it does? How confident are you in your supplier's ability to deliver? That's a really big one. If you remember the supply chain issues that we had coming out of post-COVID, you can be selling on the front end a ton, but if you can't get the product, I mean, that still looks like you cannot deliver as a company. So, understanding that if your supplier's having some issues, that you have other people that you're potentially talking with that can make sure that your business continues to be streamlined. And then the last one's the opportunity. So, who are your customers? How have their life changed over the last few years, right? Because if you're marketing to people in the way that you always have, and people are now using different platforms, or, they're not going into stores anymore, or whatever the case is, you got to be able to adjust to that, right? So just thinking through some of these things, I think will kind of just help you think, all right, if I am going to borrow, like I got to make sure that I'm throwing the money in the right area, right? To make sure that what I do is going to help grow the business and not just continually kind of, sink me because I'm investing in something that's not even working anymore. Okay. All right. So you'll be able to kind of look through that when you get your workbook. All right. So let's go into why are you a good investment? Okay. Focus on what you bring to the table as the leader of your business, right? You are your business's most important asset. And this is kind of your chance to show them that you're someone to bet on. You can go to the next slide. And it doesn't matter, to be quite honest, how great your idea is. If the lender isn't confident you're going to do what it takes to pay off your loan, they're just not going to invest in you. And that's why that business plan and those projections, once again, become so critically important. Okay. All right. So here are some things, of some questions really that I want you to think of that you need to be prepared to answer the first time that you walk into a bank to ask for credit options. Okay. So from a leadership perspective, who's your business or what is your business or management history? And the reason we want to know that is because if you are someone who, let's just say, was a contractor and you want to open a restaurant, we need to understand, did you work in restaurants growing up? Does your family have a restaurant? Like what experience do you have? Or are you potentially hiring someone that's a cook and you're really just going to be kind of behind the scenes? That's why we ask it. How did you decide to start this particular business? Right? Does your business partner or members of your management team have experience managing and growing capital? Okay. Who's your bookkeeper? Those types of questions. What kinds of professional experts do you rely on to support your business? So do you have a CPA? Are you using an attorney? Or are you kind of wearing all the hats, right? It's not to say one is better or worse. It's just that, if we know that you're working with a CPA from a banker's perspective, and we have questions about something that we see on the tax return, 9 times out of 10, you probably don't know why it's like that, right? Your CPA does. So we want to make sure that we have a relationship with them to be able to kind of help you to get this loan done. The second one being cash flow. So do you have enough revenue coming in regularly to make the payments on the loan, right? That's the common theme of today's call. And how do your customers pay you, and what are your payment terms? And the reason that's so important is because of what we talked about earlier with the payables and receivables. If your customers are paying you every 90 days, that's a little concerning to us. That do you have enough business coming in that, every 30 you're still getting stuff, but you just have people paying longer terms. And how do you accept payment? Because if you're not taking credit cards, or you don't have a invoice system set up or whatever, then maybe you're not getting paid as quickly as you can, which is ultimately affecting your cash flow. And the last one's the collateral. So, what can you put up for collateral when you're looking to do a loan, right? A lender wants to know that it can recoup at least some of an investment if the business doesn't get or doesn't succeed. Okay. All right. So let's switch gears a little bit and talk credits, personal credit versus business credit. Okay. So, most of us are pretty familiar with personal credit, right? It's kind of been with us our whole entire lives. So it's associated with our social security number, somewhere between 300 and 850. We pay our bills on time. Typically it goes up. If we're not too highly leveraged, it's the number stays at a pretty good level, right? So the business is always the one that everyone's kind of has a harder time understanding. And really they keep it kind of vague. So it's not a perfect science behind it, but I'm going to share with you what I know at least about it. Okay. The number is different. It falls somewhere between 0 and 100. And I, to be honest, wouldn't even focus on the number piece so much because a lot of times you don't even see it as a business owner. What's important is that you're building credit history. So for example, if you're a contractor, probably have a line of credit with Home Depot. Even if it's $500, you buy material and you pay it back from that line. Then that vendor reports you to the credit bureau to say, hey, they have a line with us, they pay it on time, they're in good standing. You do a business credit card. Okay, most of the business credit cards out there actually look at the person, the owner, to get it approved because they don't really look at the business so much. Now, it sits on the business credit report though once it gets approved. Now, if you're using it, paying it down, using it, paying it down, once again, you have another vendor now that says, hey, you've been using the card appropriately. We feel pretty good about this. So when you come into the bank to get a loan and we see, hey, they've got, 5 or 6 vendors out there that say that they've paid everything as agreed, that puts you in a really good standing, right? Same thing applies if you don't have anything on there. It's like, well, do we really want to be the first one to take a chance here, right? So that's why just having other vendor relationships, making sure you're paying things on time, that will help to build that business credit profile. And the one thing I will say is as much as possible, keep your business and personal credit separate. If you are using a personal account for your business operations, you've got to stop today. Okay. You've got to keep that separate. If you pay your personal expenses from your business, fine. So then you transfer and take a payroll or a distribution from your company to pay your personal stuff and transfer it and have a paper trail. But you cannot be, commingling the business and the personal. The bank is not going to like that when it comes time to get any type of credit. Okay. And it just, from a bookkeeping perspective, you need to keep that separate so you can understand what's coming in and what's going out. Okay. This will help you build up credit history for your business and will protect you and your family from the downside risk of your business. Okay. All right. So now we've talked through, all the personal credit, the business credit piece, some things that the lenders might ask, things to prepare you, questions around, should I borrow or shouldn't I? Now down to what financial data is actually important. Okay. You can go to the next slide. And probably one more forward too. All right. So financial data gives loan officers the hard evidence that you can succeed and that investing in your business will pay off. One more slide, please. The first thing is tax returns. All right. So if you're a newer business, like I said, we're probably going to look at a personal tax return and then some projections in a business plan. But if you've been in business a little while, we want to see the business tax returns. We may ask for a year, maybe potentially 2. The goal is that we want to show that a business is paying taxes. And what that means is that you're showing income. Because if you're showing income and paying taxes, that means that you can also afford to pay debt that you take on. Once again, if you're not showing any income and not paying any taxes, you're going to be in a situation where you're never really going to be able to borrow a lot of money. Okay. And if you think about it, you shift your mindset a little bit instead of not paying taxes and relying on a tax return. Think about it more from if I showed the income and paid some taxes, I could get a line of credit that could ultimately pay for my taxes and give me a shortfall for payroll or expansion and a host of other things. Okay. All right. So then after tax returns, we get into balance sheets. And this is where software becomes so important. Okay. If you are not using a software currently and you, let's say, don't have it in the budget to maybe use a QuickBooks or something like that, I am a big proponent of the software Wave. It's W-A-V-E, Wave, just like you'd wave to someone. It's a free platform that very user-friendly. If you sync it to your checking account or any form of payment that you use for your business, so if you have a business credit card and your checking account, all of that data will automatically flow into the software. The only thing that you have to do is go in there and edit it a little bit, right? So if you have, let's say, a rent payment that comes out for your space, it may just go in as a payment of, let's say, $1,000. You just want to go in and edit that line item to say rent. So it kind of flows into that bucket at the bottom. Now, when you have all that automatically doing that, it saves you all that time of having to manually enter anything. Okay. And it gives you this most important piece, which is access to your statements. So if you were to come in for a loan tomorrow and I said, hey, I need you to give me a current balance sheet and income statement, you'd be able to go into that software, go into the tab of reports and print a balance sheet from the beginning of the year to today. And and what a balance sheet's going to show you is a comparison between how much you owe and how much equity and capital you have in your business. Okay, so it's a statement of the assets, liabilities, and capital of your business. So one side literally is going to show everything that you have of value from an asset perspective. The other side on the right is going to show all the things that you actually owe from a liability perspective. And it's going to tell you, hey, do I owe more than I have in assets? Or am I sitting in a pretty good position where I own a lot of assets and I have very little debt? Right. So that's what a balance sheet kind of tells you, so that you feel comfortable maybe taking on additional debt. Because if you're already highly leveraged, like, why would you want to take on more debt? And the bank's probably not going to give you more debt. Okay. All right. So the next one is that income statement, also called a profit and loss statement. A lot of times people are like confused because profit and loss has like 3 different names. Okay. Profit and loss statement, income statement, P&L, all the same thing. What it does is basically it shows the income piece of it, right? The increase in the average sales volume of a company's products or services, typically year over year. If a company is increasing in sales, it's a good candidate for further growth, right? And the reason why we ask for a profit and loss, so think of it this way. If you, right now, for an example, you haven't filed your 23s yet, right? But if you were to go in for a loan, I'd ask you for your 2022, because we want to see how you ended the last fiscal year that you had an actual audited financial. But we'll ask you for a year-end profit and loss statement and balance sheet. Now, that's an internal document, but at least it's going to show us, hey, were you at least on pace from where your 22s ended to where your at year-end 23 looks, okay? Also, it helps you as a business owner. If you're not looking at a profit and loss statement at least quarterly, then you have no time to fix anything, right? If you're 3 months into the year and you're not on pace from where you were, let's say in 22, well, now you have time, right? Like, I can do a marketing campaign, or, hey, I'm a few $1,000s behind where I was this time last year. Or, hey, I know that I have a really busy time in the summer. So maybe if I'm looking at this at the end of summer, can I compare it to the 22 at the end of summer? Am I on pace, right? But if you're not looking at this, you have no idea what has come in and gone out at any given time throughout the year. Okay. So trust me when I tell you, these profit and loss statements and balance sheets, they are not only for the bank. These are for you to understand where your business lies at any given time. Okay. All right. So some final takeaways about those are: your P&L statement and your balance sheet are critically important to your ability to get a loan. The more organized, clear, and accurate the information you provide, the better your chances of getting a loan. And work with a trained professional to prepare these documents if you're not potentially using a software. Okay. All right. So now you've understand the statements, what we're going to ask for. Now the question is, what are your actual credit options? All right. So there are a lot of ways your business might be able to access capital. And to be quite honest, the 3 main types of credit banks offer are credit cards, lines of credit, and term loans. That's it. Everyone thinks there's a million different types of loans out there. Sure, there's some SBA things that we can partner with, but at the end of the day, it's still those 3. It's either a credit card, a line of credit, or a term loan. There's just different types of term loans. Is it for real estate? Is it for equipment? Is it for expansion? Right? It just means a different length of time. We're going to let you borrow that in different rates. But really, it is those 3. So let's I want you to think of it kind of like stages, okay? And as you get successful in that first stage, that's when you kind of graduate to that second stage, okay? So that first one, you can go to the next slide, is actually business credit cards. That is the first line of defense. And I could talk about credit cards for a whole entire hour class, to be quite honest, because I am a huge proponent of using a business credit card to not only establish business credit, but also to help with cash flow management. But there's a trick to it. Okay. A lot of times people take a business credit card and they max it out, and now all they have is a debt. Where if you actually use a business credit card to help float cash flow. So let me give you an example. A business credit card is the only form of capital that you can spend today and not have to pay it back for almost 45 to 60 days, and it costs you nothing. Okay. Now, if you don't pay it off when the bill is due, then yeah, that's when the interest starts to accrue. But imagine the scenario where we said, hey, you've got receivables that you're waiting to get in, right? You're waiting to get paid for something. Well, if you were able to purchase additional inventory with that credit card, you now float yourself potentially 45 to 60 days until that money's due. You're going to already get paid on those invoices, right? So now you've sold that inventory, you get paid, and you turn around and you pay that credit card off. And now you do it again in the next cycle, right? So now you're using that business credit card for a host of different things. You're protecting yourself from fraud. You're helping your cash flow management. You're potentially getting perks and rewards because a lot of business credit cards offer cash back or different things like that. Okay. But I just look at it as an amazing tool to not have to use your own cash, but float yourself and not be charged for it. Okay. I use everything in my personal life on my card. Now I keep a budget, right? I only spend as much as I know that I can spend that month, but I put it all on card. And then when I get paid, probably 2, almost 3 times before that bill's due, and I have that amount budgeted that I turn around and pay off that card, and I continually do that. Okay. So now you've used credit card, you're functioning with it in the appropriate way instead of, well, I'm going to say one more thing about credit cards. A lot of times people will have a $5,000 balance, let's just say, and let's say you get paid on a job and you get paid 10,000. The last thing that anybody wants to do is take 5,000 from that 10,000 and pay that card off. They don't. They'll say, well, maybe I'll throw 1,000 out of it because, I want to keep my cash in case I need it for an emergency. Listen, there is never a time, okay, rarely a time where you cannot use a credit card for that emergency. So instead of you carrying a $5,000 balance on, let's say, a 30% card, which is cost a ton of money in interest a month, you could then turn around, pay that 5,000 off. And if you have an emergency, use the card, right? Because that's what it's there for. Because if you have that emergency, you can use the card. And remember, you still have that 45 or 60 days that it's not costing you anything to potentially pay that back. And maybe that emergency is only a couple $1,000s, right? So we have to switch that mindset of, if you're sitting on a bunch of cash in your account and you're carrying a $5,000 credit card debt at 30%, the amount of money that you are spending in interest is ridiculous when you've got the money to pay it off. Okay. And you can use that card when that emergency arises. Okay, I'll stop. See, I could have told you, I could have talked about business credit cards forever. All right, so you got a business credit card, you're using it, you're functioning. Now what? Next step is line of credit. So how do they differ and how are they the same? So the difference between how I said a credit card, you can spend it today and you don't have to pay it back, potentially 45, 60 days, doesn't accrue interest if you pay it off in full. When you borrow money from a line of credit, a business line of credit, the second that you borrow, interest starts to accrue. Okay. Now, the interest rates are better, right? Because they're associated with prime. So it may be prime +1, prime +2. So maybe you're around 8 to 10% in today's economy compared to a 25 to 30% on a credit card. So let me give you an example of sometimes how people use a line of credit effectively. It should really be emergency only. Okay. If you're using, let's say, your credit card in that same example of you carry a $5,000 balance, and let's say you had a really slow month and you only can afford to maybe pay $3,000 on that credit card to pay it off that month. Well, borrow $2,000 from that line of credit and make sure you get that credit card paid off, because now you've got $2,000 sitting at 8%, right? For a little bit until you get the money, instead of it sitting on 5 and 30%, right? Of capital that you have to pay less interest when possible. And the other thing with a line of credit is you can borrow cash. So taxes, payroll, buying in bulk, right? Anything like that you would need to literally borrow cash, you would go into the line, transfer the money into your account, and be able to use that credit or that cash just like normal cash. Okay. Where you can't do that with a credit card unless you pay cash advance fees, and there's a limit to it. All right. Okay. So now you've used credit card, line of credit was that second line of defense. The third one is your business term loan. Okay. So it must be repaid with a specific time frame or term. So think about term loan like a car payment, right? It's a 5-year, 6-year payment. And boom, once you pay it, you're done. Same thing with your house, 15, 30-year. Once you're done paying it, paid off. So when you need something that you cannot physically pay off within 6 months, chances are it should be in a term loan, right? Any big piece of real estate, any piece of equipment, a vehicle, all those types of things you want to make sure that you are putting into a fixed payment so the rate locks over a certain amount of time. Okay? So back to that scenario in the beginning where you walk into the bank and say, hey, I need a piece of equipment, you need a term loan, right? Because and a lot of times under 250,000 on a loan, there's no prepayment penalty. So if you end up getting an influx of cash where you want to pay that term loan off faster, by all means, go ahead and do it. But at least you're only obligated to pay that monthly payment instead of being on some type of a variable line of credit where it could go up and down. And really that line of credit's only supposed to be used for operating capital. The term loan is for longer term debt. Okay. All right. So besides the 3 different types of loans, okay, there are some additional sources of capital that exist out there. And, a lot of times I partner with a lot of these different funds. We call CDFIs, which are community development financial institutions, because they do things a little bit differently. All right. So you can actually Google CDFIs in Ohio. And it's about the 3rd tab down, I believe. There's a nice Excel spreadsheet that will show you all the different CDFIs in Ohio. And it shows you kind of what they specialize in, whether it's, real estate, lines of credit, term loans. And then to the very end, it talks about the counties that they serve. So whether they're all of Ohio or Stark County or Lake County or, whatever the case is. So that can kind of help you narrow down to what community development financial institutions are out there and what they specialize in. Now, most banks help to fund these community development financial institutions. It's just that they take on more of the risk, right? Because maybe they do things a little bit differently. They're a little bit lighter on the cash flow equation, or maybe they look past a little bit of some credit history, right? So they're a good place sometimes to start when you maybe can't quite get a conventional loan yet. And then you kind of grow out of that into more of a conventional type loan down the road. There's venture capital firms as well. SBA, which we'll talk about too. But the venture capital funds are putting a greater emphasis on funding minority entrepreneurs and may provide some new opportunities as well that way. Okay, so then we're just going to go briefly into the SBA type loans. So like I said, it's all the same, right? Lines of credit, credit cards, term loans. It's just that SBA comes in kind of as a support. Okay. So you can go to your bank for a standard business loan, but the requirements are typically higher. Okay. If your business is new or doesn't quite meet the cash flow requirements of your bank, you might consider an SBA loan. For an SBA loan, a business can go to an SBA funded lender, like I said, such as Chase, and get loan backed by the federal government. So some advantages of it are, more time, lower down payment. You can go to the next slide. Eligible fees are typically included in the financing, and they're attractive for companies with a high level of debt or very little collateral, or they're just starting out. So kind of a nutshell of it is when you come to us, you still do like the normal process of doing a loan. And now if there are some of these things pop up, like you're newer, maybe there's a little bit of credit history issues, or there's a collateral shortfall, we then say, hey, we could do this, but we want to make sure that SBA supports it. Excuse me. So what that means is that they kind of come in and support the loan, which helps you to get the loan. It helps us to feel better because we take on less risk. And there's, benefits for both sides across the board. Okay. So don't feel like you have to kind of jump through hoops. Really, the bank kind of helps facilitate any type of SBA backing. Okay. All right. So who's eligible for these types of loans? A lot of people. Okay. As you can see, businesses with less than 15 million in tangible net worth can apply for SBA. There's a theory out there that if you're obviously making more than that, You shouldn't need to take on an SBA loan. So that's why they kind of put that kind of threshold out there. Businesses that have generated less than 5 million average net income over the past 2 years. So like I said, pretty wide umbrella for us to be able to use SBA. We'll briefly go through the 3 types. So the next slide, please. SBA Express. So this is your typical one where you're a newer business. Maybe you're coming in for a line of credit. It's anything under 350,000 for a term loan or a line of credit. So example, if you were coming in for a $100,000 line of credit, we would get SBA support potentially, and we would put up 50, SBA puts up 50, and that's how it does it. It's still one loan. It still comes from the bank. You wouldn't even feel the difference. There's just a little bit of paperwork that SBA asks you to fill out since it is government, and they ask some questions about, are you a citizen and all that kind of stuff. So then as you kind of start getting into it a little bit further, and we're not going to spend a lot of time on this because these are kind of one-offs, but you've got your 7A loan, which I didn't do a ton of when I was a lender, but it is available. It's term loans for up to 5 million and ranging from 7 years for working capital to 25 years for real estate. So let me put it to you this way. Whenever you go and do any type of SBA lending, whether it's a 7A, a 504, or an SBA Express, typically the bank should give you kind of what we call a loan comparison tool. So it should be 3 columns or even 4 columns, conventionally, SBA Express, 7A, and 504. And it'll show you what are the rates, what are the fees for each one, what am I paying, what's my term, and you can decide, because sometimes 7A will require some fees up front, but it may offer you a better rate. So sometimes people want to do that, right? Where then you have the 504, which is the next one, that all the fees are kind of rolled into it. And yeah, the rate may be a little bit higher, or maybe the term's a little bit different, but you don't want to have to come out of pocket a ton of money to get the loan started, right? So sometimes it's more advantageous for someone to go with the 504. So the 504 was actually one of my favorite loans that I ever did because it was really good terms. So for example, if you did, it was 50, 40, 10. So the bank would put up 50% of the loan, the SBA would put in 40%, and you would bring 10% to the table. And then that 40% piece, that's the SBA piece, would actually be fixed over 25 years. And the rates were like ridiculously low at that time. So think about that. If you were buying, let's say, a piece of real estate, you'd have the Chase piece, which is the 50%, right? Over, let's say, a 10-year fixed with a 25-year amortization. So your payments would still be reasonable, but you'd have to renew it after 10 years. Where that 40% piece of the SBA was locked in for that low rate for that 25 years, which was really attractive to a lot of business owners. And then only having to come down with 10%, which was really big when it came to a property. So just some overview on that. Like I said, if you're not kind of in the market for any 504 or 7A, you could research them more, but just know that they're out there and they're not any different than term loan versus line of credit. It's just more of a support to the business owner. Okay. All right. So we talked about a lot today, right? So you got to kind of begin building your own empire, right? So I hope that this presentation has helped you take one more step toward building your own business empire. I want to ask you one more question. If you want to go, I think maybe there we go. All right. So out of everything that we've talked about today, hopefully, like I said in the beginning, if you were at a 1, you're at a 2. If you're at a 2, now you're at a 3. This is just some basic knowledge around documentation, questions to ask yourselves, a couple of, things that you can do in the workbook to really kind of think this through a little bit before you come in and borrow. And don't be afraid to work with your banker, ask the questions, that you're unsure of. That is their job to kind of help you through that process. Okay. The thing that you don't want to do is keep things a secret, because when they find out the hard way, then they're just suspicious by nature for the rest of it. Okay. So be upfront, and hopefully that banker can kind of help you get where you need to go. Okay. So one more slide, I think. Yeah, questions that anybody may have. Let me take a look at the chat and see what we got here. So what are the rates now? That's a great question. So I actually don't do lending anymore right now, but they're different at all banks. I mean, prime rate, I think, is still at 8.5%. Rumor has it the Fed's supposed to meet like 6 times this year to potentially lower that. It speaks directly to that. Okay. So depending on where prime rate is, then you look at your personal credit score and the business credit score, and you either have it, like I said, prime +1, prime +2. And then some of them will fix at that if they're term loans and things like that. So, you could see on the personal side, on the home loans, they've been dropping a little bit. But the business ones kind of stay steady around prime. And what else? Is it best to stay with one bank if I have one loan or shop around? So, it's funny. I was having that conversation this morning with a client. I'm a big proponent of having multiple relationships with banks, right? I think that there's nothing wrong with that. But you got to think about it from this perspective. When you have your business account with a bank and they can see the activity that's happening, it makes them a little bit more inclined to understand how your business operates, right? If you go to a bank that they don't have your account, they don't see the activity, they don't see what kind of balances you have, the relationship that you have, it makes it a little bit more challenging for them to kind of take that leap of faith for that first time, right? Unless you have really, really strong financials, then you're probably okay. But that relationship piece is pretty big. So I would always say that whoever you bank with, I would always attempt to try there first, because of the relationship. And then obviously, once you have kind of your pre-approval or your rate, it wouldn't hurt to potentially get a second opinion and kind of see what else is out there. Good question. Anything else from anybody? Well, if you think of anything after the call, if you want to go one more slide, I think. There you go. There's actually a little survey you can take too, if there's anything else you'd additionally like to learn about. But my contact information is there. If there's anything that you think of that I didn't answer, feel free to shoot me an email. I'd be happy to answer any questions that you have. And then I would say just kind of keep an eye out for the workbook and the deck. And the question, what is normal turnaround time? It depends on the loan. If it's a term loan, we're looking at invoices of what you're looking to purchase. If it's a line of credit, sometimes it could be a couple of days. If it's real estate, I mean, we're talking appraisals and all kinds of stuff like that. So that's why I always say, if you're thinking of needing to borrow, it's better to get it started earlier, because when you need the money, you can never get it. And that's just kind of the theory. So I appreciate everyone's time today.
Okay, Laura, I want to thank you for your time and your knowledge. There's a lot of knowledge in there, and I encourage you to contact Laura if you do have any questions, or if SCORE can help you in any way. I think Laura did touch on something that I just wanted to make you all aware of, that on April 23rd, we are having a webinar panel discussion regarding small business lending. So we'll have someone from the SBA there. We'll have someone from ECDI, which is a micro lender, as well as someone from one of the local banks. So I encourage you to watch for that invitation from us, and hopefully it'll work out with your calendar. So thank you all. Laura, have a great balance of your week, and we'll talk to y'all later. So long,
Thank you.
everybody. Bye-bye.